In this video, traders, we're going to look at grading your setups to allow you to trade a bigger size. Hey traders, a very warm welcome to you. Okay, so grading your setups, I think, is crucial to being able to adjust your trading size. I've done a video on this before where I've talked about the pros and cons of adjusting position size. I know traders who are both in kind of 7-8 figure levels. One will adjust the size massively, really large variable amount. The other says, hey, you never know which one's going to be the winner. I have a fixed position size. Both are doing well in the market. Which one's right? I like to sit on the camp of the side that says, you know what? When things are lining up in your favor, you pull that trigger and you push your chips right in. I've seen a lot of guys, I think that's generally the preferred way of doing it for most traders who are operating in that kind of 8-figure level or 9-figure level, obviously if you're running funds and what have you. But the 8-figure level guys, they are doing that. When they see the opportunity, they're not afraid to take some risk and really drive it home. So how do we do that? How do we decide when to take risks? Now, obviously, if we're trading just on hunch and deciding to put the chips in when we feel good about it, that's going to be a recipe for disaster because we can't measure it, we can't qualify it, we can't quantify it, and we're opening ourselves up for emotional order, or trading from an emotional perspective and using a different part of our brain. Right, so one way of doing it is to grade your setups. And I think you should be doing this anyway, regardless, because ultimately you only want to be taking your very best trades unless you're kind of forced to take lesser trades. And that's when you think about taking them with lesser size. But in reality, you shouldn't really be taking anything that's kind of graded C and D. We'll talk about this in a second, the grading system, but you'll see where I'm going with this. So anyway, let's talk about it, and then we can kind of digress and we'll go with the flow with it. So grading them, 5-star, 4-star, 3-star, 2-star, 1-star, or A to B, or 1 to whatever, however the kind of nomenclature you use is, doesn't matter. Here I've just gone A, B, C, D, and I've got an A-star trade, which is kind of the very, very best. Obviously, D being the worst, A being the best. Should be self-explanatory, that, guys. Okay, so just kind of examples for me, and these are kind of genuine, but I haven't dug down really deep into each of the setups because each of the setups and strategies alone are kind of a lot of rules for them. But in my grade A setups, I've got flags. I love flags, got fakeouts, and I've got my first pullback trade. So these are my very, very, very favorite trades. These are the stuff that actually I trade them the most because they're the best trades. I have the best success with them. I like the way they work. I know to spot the conditions they work best in. It's all good. B, I've got my 3-minute cycle trade. I've got a VWAP pullback. I've got an opening drive trade, and I've got a gap fill trade. Now these are good, but they kind of slip in and out of A and B. In other words, I won't take these all the time, but under the right conditions, when I've got a few more green flags ticked, I'll take those because to me they kind of go into the A category. So a 3-minute cycle trade is a kind of a trend trade intraday based on a 3-minute chart. A VWAP pullback, again, kind of trend trade pulling back to the VWAP. Opening drive trade is exactly that, a drive off the open that I'm jumping on board, and a gap fill is, again, a stock has gapped based on earnings and we're filling the gap. So the difference with this is that the reason I like the A's versus the B is I can quantify my risk significantly better with these. These are good trade setups, but the risk is a little bit wider because the stop has to be wider by the very nature of the play. The cycle trade, the VWAP pullback, the opening drive, the stop has to be a little bit wider, of course, and so I don't like them in terms as much as these in terms of risk reward ratio. And then we've got C grade trades, which are trend line breaks, head and shoulders, double top, double bottom. I won't take these unless I see them as part of an A grade setup or as part of a B grade setup, and it's sort of like a hybrid. And then you've got D, which is anything else. In reality, you shouldn't be taking anything else, but what you can do is you can allocate it as a test column. So there's a test, these are strategies you're testing out and trying, and they're in the D column. And then I've got the A star column, which we'll talk about in a second. So the idea is that we decrease the position size and adjust the position size depending on what level it's in. So if we're in testing mode, we might only trade 1 unit. Whatever that unit is to you, it doesn't really matter. A pound a point for spread betting, £1,000 a point, 20 contracts, 5,000 shares, it doesn't matter. adjust your unit size on a separate kind of document based on the money you've got to allocate to risk capital, trading account, all the kind of stuff that you need to do. So maybe I'll use that as a tester and it's 1 unit size. C, like I say, I'm not going to be taking any C's, so I wouldn't have any unit size for there. Maybe now I'm looking at B, I'm going to take that for 2, twice my unit size. I quite like these trades on 2, and then maybe for my grade A's, I'm going to go 4. Right, so 4 example is the position size that I would use. Now, it might be a bit confusing. I've gone 1, 2, 4. That's 4 times as much. Probably think of it the other way around, as this is 1 and this is a quarter, if that makes sense. So I'm not kind of quadrupling my position size risk. I'm latching it down by 3/4 to a quarter for the D grade. So however you do it, I've got this variable amount of position size that I'll take. Now, when we have the A star setup, and for me, the A star setup is the A grade setups that have extra weight behind them that mean that I can really go in for it. So, in other words, these would be like high tight flags, which is what I've already got in my A grade setups. They will also have the addition of a catalyst, an external catalyst like news, data, earnings, etc. They will have good volume. I put 3 times volume just as an arbitrary amount, but good volume. If it's a stock, then I can pick out 3 times volume. If it's a futures contract, if it's if it's an index or it's commodity or currency pair, it would be better without the 3 times volume, because you're not going to get 3 times volume on a currency pair. You're not going to get 3 times volume on an intraday chart. Okay, tight risk. So if I can quantify the risk, these are in A grade setups anyway, but if I can quantify the risk better, i.e. it's a nice tight risk and it's an obvious risk, not just like, oh, I'm going to put my stop really tight because I feel like it. No, the thesis of the trade is still true, and I can still have my stop nice and tight. That's a good indicator it's going to be in the A star setup. An obvious target, so I don't have to think about my targets, or it's got room to run, or loads of things where, hey, it's almost like I can feel that's a magnet for the stock. I can feel that's a magnet for the trade. You know, it feels like it wants to go there. It's setting up. It's almost like it's setting up for that move, and that's a kind of bit of intuition with that one. In tune with the market. So this is personal stuff now. How am I feeling with the market? Have I been trading well? This is 2 things together actually. In tune with the market, performing well. Am I in tune with the rhythm of the market? Am I kind of know where the ebbs and flows are? Am I performing well in terms of have I done the last few trades, the last few weeks, months, years, whatever it may be, how far you need to go back depending on the time frame you're trading. All right, and then like I say, high tight flag, or another. Actually, this one would be separate. This is a prior fake or sentiment shift. So in other words, that would be the final thing that I'd go, yeah, you're now in an A star grade setup, which is like an intraday change in sentiment. We've had a good up run, and then for some reason the whole thing's just changing now. It's gone completely bearish. And then I kind of see the A grade setups in there. It's already faked out the upside, caught a lot of people out potentially, and now I'm trading in direction of the new flow. Got my catalyst. Maybe there's been some kind of news come out as well that's done that. Got some good volume coming in. I quantify my risk better. So now I might go 8 times here, or I might go 10 times, whatever it may be. It doesn't actually matter. The point is, as long as you plan it out, you don't do it on the fly. Now you might say, well, that seems ridiculous, because if you're taking 10 times the risk here, don't forget, this isn't really 1, this is a quarter. This is really your 1. So you're kind of doubling your risk a little bit more on your A grade setups. Maybe you can triple your risk. The point is, as long as you understand the quantity of risk you're taking, the monetary amount of risk taking, and it's acceptable to you, and say, you know what, if I lose on this, I don't mind, because it's the kind of stock, it's a kind of market I want to go in all the time for. You can do it, and that is how you can grade your setups and then allow you to dial up or dial down your position size based on the quality of your setups. So let me know your thoughts on that, guys, in the comments section below. Obviously, this is going to be different for every single person depending on the setups, so your swing trading, day trading, the markets you're trading, etc. But just spending some time going into some depth and grading the setups that you've got, your library of strategies and setups and trades, grading them in terms of what's the very best one you'd like to see, all the way down to the ones that you don't want to see. Discard some of those and then say, you know what, even if you don't grade them like this, even if you just say, maybe say have one that's your absolute peach, it's a gem, and when you see it, you know what, you say, I'm going to double my size now, I'm double my risk. I normally risk X amount, now I'm going to double it and risk this amount. As long as you're happy with that and if you're comfortable with that, then that's how you can press and learn more and really extract more out of the market when the conditions are right for you. All right, guys, hope you enjoyed the video. Give it a thumbs up if you did, that's much appreciated. And of course, subscribe if you haven't yet already to the channel. Thanks again, guys. See you then. Take care.